Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, May 16th, and you're tuned in to On Trend, the show designed to keep you on the right side of the trend. So we're going to look at these oversold bounces. We're going to focus on semis, check in on treasuries, and finish with some stocks to watch. So we're going to start off with the major index ETFs because they are getting oversold bounces. We first saw RSI move below 30 to become oversold 5-period RSI. And then we saw the percentage of stocks above the 20-day EMA move below 30 to become oversold. And both of these have since bounced. So the first three charts I'm going to show are going to be SPY, QQQ, and IWM. And I've got the same indicators on each chart, and I'm showing candlesticks over the last 9 months. So here we can see SPY, which kind of serves as the benchmark because I think it's the most important index ETF out there. Of course, it's based on the S&P 500, which is the most widely followed benchmark for the U.S. stock market. And so I think support and resistance levels matter more for the S&P 500 than other indexes or ETFs. And so using SPY as our proxy for the S&P 500, you can see the high here in March and a little low and a consolidation there later in March. And those two combine to mark a resistance support and now a support level there in the 280 area. And so we've come down to that level. We had the gap down and the indecisive candlestick there on Monday, and we firmed on Tuesday, and we got a nice bounce on a Wednesday. So it looks like we're bouncing off support. Whether we hit new highs or not, I don't know, but I do know, or I do think, that the bigger trend is up. S&P 500 hit a new 52-week high. The 200-day, which is not shown, we're above the 200-day. The 20-day is above the 200-day. The breadth indicators are net bullish, and I featured all of that in last Tuesday's, or this past Tuesday's On Trend show. If you want to go back and get an idea of what the long-term picture is, it's still bullish as far as I'm concerned. And when I say long-term, I'm not looking out 2 years. I'm not even looking out 1 year. 3 to 6 months is about as long-term as I can get. So that's the way I do it. I'm kind of a medium long-term, if you will. But if I work under the assumption that the bigger trend is up, then that means when we get a pullback like we did here, that is considered a correction within the bigger uptrend, and we want to look for areas of potential support. And so we're getting one of these areas of support. We can see that RSI moved below 30 twice there. Sometimes you get the double dip, and now we're back above 30, so that coincides with the oversold bounce. We can see the percentage of stocks above the 20-day EMA moved below 30 and is now back above 30 with strength on Wednesday. So that's a bullish signal as well. So that points to an oversold bounce. And of course, if we don't hold yesterday's low, then that would call for a reevaluation of this bounce. So moving down to QQQ, we can see a similar pattern or setup in play on that chart. First of all, you can see that we have declined around 7% after hitting a new high. So, after a 33% or 34% advance, a 7% decline is not that big of a deal. All right, it is a normal pullback at this stage. And we had the gap down to shake everybody out, and now we're filling that gap with a big move up on Wednesday. You can see RSI was below 30 the last few days, but it moved back above 30, so it's not oversold anymore. And we can see the percentage of NASDAQ 100 stocks over there on the left. You can see that symbol, exclamation point GT20NDX. So it was below 30, which I consider oversold, and we've moved back above 30. So now we're turning up not the majority of stocks, of course, because it's still below 30. But when you're oversold, that means the majority of stocks have sold off. You're still in a bigger uptrend, and now that some of them are turning up, it is time to think about the bounce in the NASDAQ 100 or QQQ. So I would be short-term bullish on this chart as well. And if you close below that low, then you would have to reevaluate. Now we look at the Russell 2000. And, if you're looking at patterns, say flags and breakouts and stuff, you can see this, channel here, and we got the breakout, and maybe you're going to mark support here and we're above it, but you broke support here. But if you're trading on the indicators, if you're a mean reversion type trader, you're not going to look at support and resistance levels, believe it or not. And I'm not that big of a fan of support and resistance levels for these indexes and ETFs with lots of moving parts. So the green lines mark the past signals when you had both the percentage of stocks above the 20-day EMA move above 30. And this is for the small cap, the SML, the S&P 600 small cap ETF. And you had RSI move above 30. And so those green lines show you when both of these instances occurred. And you can see sometimes you get early, sometimes you continue lower, and sometimes you get one heck of a bounce. Now, I don't know if I would have taken the signals here in late October and November or in early January because the bigger trend was down. But in March, the bigger trend was up. So you definitely had a signal there. Didn't last long, but we had a second signal here that gave way to a higher high. And now we've got a third signal here. And if you're interested in candlesticks, the candlesticks on Monday and Tuesday form what's called a harami, or an inside day as well. And so you have the black candlestick with selling pressure, and then you immediately firm, and all trading the next day is within the boundaries of that black candlestick there. And so that is a day of indecision, and now we're starting to move up, and so it looks like IWM is going to get a bounce. And there you can see the indicators are also triggering with RSI moving above 30 and the percentage of stocks above the 20-day EMA moving above 30 as well. So now I'm going to look at these same indicators for the 6 big sectors. And the reason I'm only looking at 6 of the big sectors is because these are the ones that drive the S&P 500. Here I am on the State Street website, SPDRs.com. And if you click on the holdings for SPY, you can see there the individual stock holdings. And then if you look at the fund sector allocation, you can see that technology, healthcare, financials, consumer services, consumer discretionary, and industrials, those 6 sectors account for like 78% of the S&P 500. And so they are the main drivers and really are the ones we need to focus on. These other 6, Staples is still pretty big at 7.4%. But, these last 3 are kind of like rounding errors: utilities, real estate, and materials. So StockCharts also calculates and publishes the percentage of stocks above the 20-day EMA for the 11 sectors. And I've got these in a chart list here, and I'm showing all the symbols plus the S&P 500 for reference. And you can see that they all begin with exclamation point GT20, and then you've got the sector symbol. So it's very easy to find that symbol. And notice you hover over it, and you get a little chart that shows you what it is, the actual 1-year chart here, or a little less than 1 year. And we can see here that I'm sorted by the close, and the biggest, or the ones with the most stocks above the 20-day EMA, are your 3 defensive type sectors: real estate, utilities, and staples. And healthcare is also up there. So, these 4 sectors have held up the best over the past few weeks. And then you look at the ones with the lowest percentage above the 20-day EMA. You've got consumer discretionary still below 20%. You got technology, which is above 30%. Finance just above 30. Industrial is just above 30. So let's look at these charts. So if we want to get a position for the broader market, it often helps to break it down. And the first breakdown would, of course, be at the sector level. And you can see which sectors are leading by when they triggered their bullish signals. And so on the indicator frames down below, or windows, I've got the percentage of stocks above the 20-day EMA. You can see for XLY, and it's at 1875. Now, as far as the signal line is concerned, I've got it at 20% instead of 30% like I had it for the S&P 500 and the NASDAQ 100 and the Russell 2000 or the S&P Small Cap 600. And the reason is because a sector is a more homogeneous unit. All right, it's a bunch of stocks that are supposed to be in a similar economic group or whatever, and they're supposed to move more or less together, like industrials, materials, healthcare, technology, and so forth. Yeah, you could argue that the NASDAQ 100 is pretty much technology. So that's the reason I put the bar at 20% and 80%. And when the bigger trend is up, I'm only looking for oversold readings. I'm not concerned with overbought readings. And you can see here that RSI moved below 30 and above 30 where that blue line is. And that was a really good signal in March. And then you can see we have the percentage of stocks above the 20-day EMA moving below 20%. And then it did move above 20% on Tuesday there. So we got a signal, and RSI moved above 30. So we've got a double signal working there. I probably need to move that one more. But it looks like this one's getting a bounce too, and it's above the rising 200-day moving average. If we look at communication services, Google, Alphabet had a big move yesterday, and that's the reason we got a pop in XLC. It's the biggest holding. You can see here that we have a potential support zone, kind of resistance, a little consolidation there. There's the flat to slightly falling 200-day. But we came down, had that doji, and it's a doji harami actually, because you're a candlestick, and the doji is inside the body of the previous candlestick. So it's an inside day, it's indecision, and now we get this bounce. And you can see that RSI moved above 30, and the percentage of stocks above the 20-day EMA moved above 20. So there you can see that indicator for XLC. So that one is in sync with the market. And then we look at these same indicators for XLK, which is by far the biggest sector. It's like 22% of the S&P 500. And you can see a little support level there from late March, that little dip in consolidation for 4 days. And we hit that, and we're getting a bounce with that move up on Wednesday. And you can see RSI moved above 30. Percentage of stocks above the 20-day EMA also moved above 30. Then we look at finance. This is still one of the weaker sectors, but you can use this percentage above the 20-day EMA to compare the pullbacks. If you notice, finance, the percentage of stocks above the 20-day EMA did not go below 30, so it did not become oversold. RSI did become oversold and moved back above 30, so you got a little bounce there. If you look at the last two signals in XLF, you had one in the middle of March, and you had one in the latter part of March. And that one in the latter part of March proved to be pretty good because you moved from 25 and change to 28. Looking at industrials, XLI, we can also see a signal materializing. There you have support from two lows there in that 74 area. And you got the 200-day. So we came down to support, got oversold, and now we're moving above 30 with RSI, and we moved above 30 with the percentage of stocks above the 20-day EMA. So that is in play. And then finally, healthcare. Now, as far as the long-term trend for healthcare is concerned, it is flat at best. All right, we can still see a rising 200-day moving average, believe it or not. You know, it's flattening out a little bit. But, you know, we've got lower highs here, and we got a higher low here. So it's kind of like a consolidation, basically, one big trading range. So we were very oversold in the middle latter part of April, and we got the signal from the two indicators. And we got another signal with both of them moving above 30 here over the last 2 days. So healthcare could get a bounce as well. So it looks like all six sectors are getting these oversold bounces. Some of them are at support, and you got to watch yesterday's low. If you see, say, 4 of these 5 break below yesterday's low, that would totally negate the bounce and call for a reevaluation. All right, now I want to turn to semiconductors, and we'll look at some stocks after this. And I want to show the difference between 14-day RSI and 5-day RSI and how you can use them both in different ways. So first of all, on the SOXX chart, we can see there's that big breakout and new highs in March and April. And it was a big move, 145 to 215. And we had a really hard decline, it seems, but we're back to the breakout zone, and we retraced around 38% of the prior advance. And so that was the first place to look for support, and we're getting a bounce. And you can see in the indicator window, I've got 14-day RSI, and this is more or less my trend type of RSI. You can see when it's in this 40 to 80 range, you're in a nice uptrend. We got below 40, but we didn't become oversold. And I think as long as RSI doesn't become oversold, that could support the uptrend. If you get enough downside momentum that RSI, 14-day RSI, keep in mind, becomes oversold, then you might be thinking about a bigger trend change, but I haven't seen that yet. All right, we've got one shoe. If the second shoe drops and we break 190, that might mean a reevaluation. Now below that, I've got 5-day RSI. And 5-day RSI is not used to define the trend. It's used to identify oversold levels when the bigger trend is up. So the bigger trend has been up since February at some point. And so when RSI 5 goes below 30, you become oversold. And when it moves above 30, you prepare for a bounce. And that was a really good signal in March. And you can see the equivalent would be RSI 14 moving to around 50. All right, it did that here in early March and in mid-March as well. It moved below 40 here. RSI 5 moved well below 30, and now it's back above 30. So it's giving the signal for an oversold bounce here or a continuation of the uptrend. Now, if we look at the broader base semiconductor SPDR, we can see a similar setup emerging here. We can see that we have this resistance zone, and we got higher highs and 52-week highs there. So that tells you we're in an uptrend. We're above the rising 200-day moving average since February. There's also a breakout there above the November high. So this is a sharp decline, 90 to 80. But we're oversold within a short-term uptrend. You can see RSI 14 did not go below 30. RSI 5 did go below 30 to become oversold, and it has since moved back above 30 to alleviate that oversold condition and suggest we're getting a bounce. So looking at semiconductor stocks, the first one I want to focus on is AMD, good old Advanced Micro Devices. And this is a chart I posted on Monday in the Don't Ignore This Chart blog. So it goes till May 10th. But we were in these blogs, you can click on the chart and then you can click to see a live version. And so now I've got a live version with up-to-date prices. And there we can see AMD is still within this channel, but it had well, let's see, let's go back here. We have 2 lows there to give us support at 16, and we have a rising 200-day, we're back above. We have a higher high, a pullback, a breakout, and another higher high, and another higher high, and then this pullback, and you can see this resistance zone turns into support, and so I would expect a breakout here and a move to new highs in AMD. And you can see RSI is in its bull range. It hasn't dipped below 40, so it's holding up relatively well during this May pullback. Now I've got a handful of semiconductor stocks to show you, and the first one is Applied Materials. And since we're on the subject of RSI, notice that RSI did go below 30 for Applied Materials, and it didn't for AMD. And so you can just compare RSI values over the last few days to see which stocks held up relatively well. Those that dipped below 30 had deeper dips. those that held above 30, like AMD, had much shallower dips and held up much better, and they could be the ones leading if the market continues its rebound. Now, looking at the chart for AMD, we're above the 200-day, but the 200-day is falling, so that's kind of a mixed report on the long-term trend. But we did get a breakout there, and you kind of have a breakout zone that turns into a support zone in that 37, 38 area. And we pull back, and we're bouncing off that with strength. All right, we had that gap down on Monday. Well, AMD has already filled that gap and is getting a nice, strong bounce there. And RSI is back above 30. So AMD, AMAT, Applied Materials, is getting a nice, strong bounce here and is looking positive. Here's Cypress Semiconductor, and here's an example of a little bit of relative strength on the pullback. You can see that RSI did not go below 30 for Cypress Semiconductor. It held up better on the dip, relatively speaking. But we can see a resistance zone here, kind of turning into support and holding. And then we had a consolidation, a triangle, and a breakout. And we've kind of come back to that breakout zone. Yeah, we overshot on Monday, but the market is always overshooting, and it looks like we're bouncing here and ready to go higher for Cypress. Then we look at Lattice Semiconductor. Look at how good this one held up. It's a low price stock, so it's going to carry above average risk. But you can see, the breakout above this resistance zone with the gap, and it just continues to work its way higher. It gapped up, fell back, but it's still an uptrend, and I would still be bullish on Lattice. And if you look at the RSI range, it did not dip below 40, so it's holding its bull range. Looking at Microchip Technology, now this is part of the problem with these semiconductor stocks like Applied Materials and Microchip. You can see that RSI dipped below 30 to become oversold, so it was a pretty strong decline. You can see you're just above the 200-day, but the 200-day is, you could say it's falling, I would think, here a little bit. But if we look at this resistance level that was broken that turns into support, and we held it, we had this kind of nice, let me change that out here to a line. We had a nice little channel wedge thingy and a breakout. And ideally, we would have held support in that 87, 88 area, but overshot, which happens. But we're in a support zone still, and so I'd watch Microchip for a bounce. Universal Display is one of the stronger semiconductor stocks. You can see this resistance zone and the breakout with the gap, and it continues to work its way higher. And RSI did not go close to 30 there. And we can see Sun Power, part of the solar energy group, and we can see a resistance zone there and a breakout. And I'll change my color back to green. There you can see the resistance zone and the breakout. And we had what looked like a little flag type pattern, and we're breaking out of it. Again, a low price stock, so that means it carries above average risk. And then you look at RSI, it's in its bull zone there. It did not get below 40, so it held up quite well. And Texas Instruments. Now, it's one of the stronger overall because you can see we had that 52-week high there. We had the breakout from the double bottom. You had two lows here in late October and late December, and then the breakout and above the 200-day. And there's a big consolidation right here in February, March. So somewhere is support here from this consolidation. In the middle, maybe 106, and we're getting a bounce there. All right, so I want to go over Treasury yields here. What I've got is a chart showing the U.S. Treasury yields. We've got the 10-year, 30-year, 5-year, 2-year, 1-year, and 3-month. And if you notice, the 3-month is at 2.42%, and it is above the 1-year, the 2-year, the 5-year, and the 10-year yield, which is at 2.37%. And the Fed funds rate is around 2.5%. So this is a partial inversion of the yield curve. And the reason I say partial, because you can see the 2-year, the 10-2, which is typically what is used, is still positive. But there we can see the 10-year minus the 3-month is negative for the second time. It was last negative in March there. So the second time in 3 months. But there's clearly some inversion going on, because there you can see how these yields rank up, with the 5-year the lowest, then the 2-year, the 1-year, the 10-year, and there's a 3-month. The next one above it is the 30-year, which is way up at 2.82%. Now, to create this chart, what I did was I used the price same scale as an overlay, and then put those Treasury yields there, and then change the colors to my liking. And then also to subtract one from the other, you just enter the symbol. And here I've got US 10-year minus, and that is US 2-year. And that's how you can do the difference. Now, I don't want to extrapolate a message from the bond market as far as what it means for the stock market or gold or the dollar. You know, this extrapolation stuff, there's just too many variables at work here, and I prefer to look at the individual charts. And as I showed you on Tuesday, my bulk of the evidence remains bullish for the stock market. And so I'm not bearish on the stock market yet. I mean, I know what it would take to turn me bearish, but that hasn't happened yet. And I'll just wait till I get a signal. But if I look at bonds, you know, TLT has been in an uptrend since this breakout of the wedge, and had a smaller wedge and broke out again. It's above the rising 40-week moving average. And if you look at the 30-year yield, it's below the falling 40-week moving average. So that points to lower Treasury yields. And here is the 7 to 10-year Treasury bond ETF, and it's also above its rising 40-week moving average. That is a 52-week closing high so far. And you look at the 10-year yield, it's below 2.4%. And as I've noted before, I think it's headed towards 2%. All right, now I want to highlight 3 stocks that I think are still on trend. The first one is Fiserv, and it had this big move above the 200-day. It's still above the 200-day. You can see the 200-day there is rising. We had basically a resistance zone there, and there is a breakout. And you can see we had this pullback to this breakout zone. That's like a throwback, and we're bouncing off this support level here for Fiserv. And if you look at RSI, it didn't even come close to 30, so the pullback was relatively mild. The next is T-Mobile, and it is showing strength as it hit a 52-week high last week and remained strong. If you want to do your patterns here, maybe have an inverse head and shoulders of the continuation variety, but the bigger trend is clearly up, and T-Mobile shows some serious strength here in May by holding up very well. And Workday is another one. Software stocks have been very strong. Coupa is another one. And here is Workday breaking out of a triangle consolidation. You had a little bit of a throwback when the market got weak. Maybe it's some sort of a flag wedge, and we're breaking out and on the verge of hitting new 52-week highs. And look at RSI. It keeps bouncing off that 40 to 50 zone. So it's one of the stronger stocks here in May. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.